Hello everyone, welcome back to Two Hats. Have you just found the house of your dreams and you're ready to sign the contract? Hold on a minute. Before going to the bank and sell your soul to the devil, listen carefully to this video. I'm sure it will help you out. In today's video, we'll break down mortgages, how they are intrinsically connected to interest rates, and what are the most common mortgage structures usually available in Europe. As always, I prepared a detailed spreadsheet so we can run some numbers and make this as practical as possible. So enough chit-chatting, let's start. A mortgage is typically associated with the purchase of a house and is likely to be the biggest loan you'll ever take in your lifetime. Congrats for that. It is a binding contract between yourself and the bank, in which the bank lends you the money you need to finance the property under agreed terms. The three key variables in these terms are interest rates, they represent the cost of borrowing the money, duration, how long you will have to repay the loan, and finally the type of mortgage. So different structures affect payments and flexibility over time. Let's analyze this more in depth. Interest rates determine the cost of borrowing and can have a huge impact on the total cost of your mortgage. In Europe, rates vary significantly by country due to national economies, central bank policies, and other factors. A good starting point is the European Central Bank rate, currently sitting at 3.15%. So this is the rate at which banks borrow from the ECB, and they add a margin when offering mortgages. So expect a higher rate for your loan. There are three types of interest rates. So fixed rate, the rate stays the same for the entire length of the loan. Variable rate, in which the rate adjusts periodically, it can be monthly, quarterly, or annually. And finally, a mixed option, a combination of both fixed and variable rates. Now, let's jump into the spreadsheet and analyze how these factors influence your mortgage. Okay, and here we are on the dashboard. So where do we start from? A mortgage usually consists of a property cost, so the price of the asset you're trying to buy. For the sake of the simulation, we will go with 800,000 euros. Can be an apartment in Luxembourg, even a house, depending on the locations. Registration fees. These are the taxes paid to the state in order to make the transaction. Of course, it can vary a lot among countries. Here in Luxembourg, we are currently sitting at 3.5%. It's a temporary percentage. It used to be 7%. It will remain 3.5 until the end of June 2025. 800k plus registration fees, 3.5%, 28k. Total asset cost, 828k. Another important factor is the principal, also called deposit, that you have to pay up front in cash when making the transactions. The stake you are putting in order to convince the bank to borrow you the money. Some banks require 10%, others require 15%, let's say 15% for the simulation, which is 120k. 828 minus 120, we will have the amount of the loan that we need. In this case, 708,000 euros. Here you can already easily see that the higher your principal, the smaller the loan. So meaning lower monthly payments and less interest paid over time. The lower your principal, the higher the loan, increasing both your monthly payments and the total interest costs. Now, to go through all the mortgage types, we will assume a loan duration of 30 years, which is pretty standard. But later in the video, we'll discuss how loan duration affects your finances in the long term. Fixed rate mortgages, as said before, have a fixed interest rate for the entire length of the loan. We are saying that we are on an interest of 3.5%. The first advantage that we can see here on the chart is the predictability of payments. By fixing an interest rate, you will know exactly how much you will have to pay by month, and you can budget accordingly. Here on the chart, you can see the payment is always the same for the entire duration of the loan. Another advantage is that you have a kind of protection from rising interest rates. On the other hand, we have higher initial interest rates compared, for example, with other mortgage structures. Especially at the beginning of the loan, you will pay a lot more interest than equity. In this case, basically, we will have to wait until month 126. We will pay for 10 years more interest than equity. Finally, another disadvantage is less flexibility over time. If the rates, instead of increasing, will drop, you are stuck with your interest rate, and the only option would be to refinance the mortgage. And here on the dashboard, you can see that we will have an average monthly payment of roughly 3,000 euros. The total cost of the mortgage, the monthly payment multiplied by the duration of the loan, and the total interest that you will pay to the bank for borrowing the money, 430,000 euros. Now, let's jump to variable rates. Here on the dashboard, you can see that we are able to modify the interest rates and make some sort of simulation for the entire length of the loan. So we'll say at month 0, we will start with 3.5% as the fixed rate before. After 5 years, we will be, let's say, with a hopefully decreasing rate, 3%. At year 10, things are not going as expected and is going up, is keep going up. Basically, it's like Armageddon will go to 6%, just for the sake of the example. And here we have an average monthly payment, the total cost based on average, and the total interest that you will pay for the entire duration of the loan. As you can see here in the chart, the payment, so the blue line, is variable. You are paying different amounts in relation to the current interest rate. One advantage of this system is that usually at the beginning of the loan you will have a smaller interest rate compared to the fixed one, resulting in a smaller monthly payment. Another obvious advantage is that if the rates drop, you are saving a lot of money over time. On the other hand, disadvantages are uncertainty, because if interest rates rise, your monthly payment will rise, and that could lead to unaffordability, risk of going bankrupt. Finally, another disadvantage is that because of this uncertainty, it's more difficult to plan your financial life. If you go with this type of mortgage, you should plan it accordingly, having an emergency fund or something like that. Having done variable rates, the dashboard also allows to structure a kind of hybrid options. Some banks will offer you a fixed rate period, let's say for 5 years, and then you could go into variable. This can have some advantages. For example, if you believe that rates will drop, you can possibly gain for these potential lower rates. By fixing the rate in the first part of the mortgage, you can have increased stability, at least for the first years. Another type of structure could be interest-only mortgages. You are paying for the first part of the loan only interests on your loan, without building any equity. For the sake of the example, let's say 120 months, 10 years. At month 0, we'll start with 3.5%. It's gonna be the same until month 120. And then after 10 years, we'll say you will pay, let's say, I don't know, 2%. 2%. You can see on the chart, for the first 10 years, you are only paying interest. Your principal is 0. What are the advantages of this type of system is that you will have overall a lower initial payments. So for short-term cash flow, this is going to be beneficial. You will have more flexibility to invest your money elsewhere or to use it in another way. The biggest disadvantage is that you are not building equity during the interest-only period. And after that, you will have higher payments than the ones you are starting with. I'll let you play with these dashboards. Now that we have covered mortgage types, let's look at how interest rates and durations will impact costs. I wanted to start from the interest rates. For this 700,000 euros loan, I plotted here what is the average monthly payment according to a fixed interest rate. In the first case here, we have a monthly payment of nearly 2,000 euros. So in this case, we are only building equity, 100% equity, zero interest, because of course it's plotted to zero. And compared to the other extreme, in which the interest rate is at 5%, we would have here 3,800 euros. It's basically the double. This graph only to let you understand how much is important the interest rate, and also how much every single basis point will count at the end of the day into the budget. I did plot the loan to a fixed rate mortgage. I analyzed a 10-year length, a 20-year and a 30-year loan. The monthly payment for a 10-year loan will be the highest, but we will have a lower cost and we will basically pay less interest over time. 10-year option will cost only 125,000 compared to the 30-year option in which we will spend 433,000. So what's the rule of thumb in this? Usually 10-year, 15 years mortgages, you will have higher monthly payments, but less interest overall. For a 20-year loan, you will have balanced payments and interest costs. And finally, for a 30-year loan, you will have lower monthly payments, so more affordable to most part of people, but overall we will pay a lot more interest to the bank. Why are we doing all this? What's the important question? Will the mortgage be approved? Will you make it in buying a house? Banks usually assess key financial indicators before approving the loan. And the first most important is obviously the total net income, your earnings. For the simulation, we will say a total net income of 8,000 euros. Here you can select the mortgage type. Okay, let's go with fixed rate. We are on a 30 years duration, and the system will give us directly what will be the monthly payment. Another important factor that banks will look at is the debt-income ratio. Here in Luxembourg, I know for experience that will not allow a debt-income ratio higher than 45%. If you are earning 1,000 euros, you can spend at most 450 for your mortgage, because they evaluate that you will need all the rest of the money for your living expenses. Another important indicator is the loan to value, which is the loan amount divided by the property value, expressed as a percentage, and it's a risk indicator for both lenders and borrowers. A high loan to value means that we are in a riskier situation, and some banks may require you to add mortgage insurance, for example. On the other hand, a lower loan to value indicates that we are in a safer condition, and you can also get better terms. And finally, here we have the mortgage feasibility. In this case, will be a yes, presumably, because we will have to pay 3,170 euros, but for a net income of 8,000, our debt income ratio is almost 40%, which is okay, might be okay for the bank. And finally, just for the fun, I added how many months of salary you need in order to pay the asset. For our example here, it turned out to be 100, but I read in a recent article that in average in Luxembourg, this number should be 246. Tell me about your country. Where are you from? And write it down in the comments how many salaries you need to buy a house. There are some things that I did not count into these dashboards, The most important is tax deductions and subsidy. Some countries allow to deduct mortgage interests from your taxable income, reducing the real estate costs over time. And this is quite advantageous. For example, here in Luxembourg, they do it. Other options are also currently eco-loans that offer better financing conditions for energy-efficient homes. And also here in Luxembourg, we have the Billigen Act. Is basically a credit for every person that helps you reducing the registration fees. It should be capped at 30,000 euros per person. Choosing the right mortgage is a major financial decision that requires understanding interest rates, loan structures, and also tax benefits. Now that you have all this knowledge, make sure to download the spreadsheet, play with the numbers, and see what works best for you. And here we are. If you found this video helpful, smash that like button and subscribe to the channel for more real estate and finance insights. I will see you to the next one. Ciao.